Good morning, traders. Welcome to the stream. My name is Charles Gough. I come from a community called Pirate Traders, where we are focused on the ES, the NQ, and how they move through the two-way auction process. And let me tell you, this morning, the two-way auction process is giving us an unbelievable edge. So basically, let me try to walk you through this step by step and give you context to understand how we can make predictions about what the market is going to do today in a way that we can enter trades based on what the market has been doing. Okay, so let's just take a few steps back. First things first, the market has momentum down. Okay, what do we mean when we say the market has momentum down? One second here. My epic pen stopped working. Okay, so what do we mean when we say the market has momentum down? Well, basically it just means that the sellers are in control of the market. The sellers want the market to go lower, and every chance they get, they keep pushing it lower and lower. Okay? And so we should assume that this week the market is going to keep going down. All right, let's start by zooming out and taking a look at this on different time frames to give us a context. We like to do what we call the top-down approach. So we'll start by looking at a monthly candle to give us some context of what's happening on a monthly candle. Then we'll look at a weekly, and then we'll look at the daily, and then we'll zoom in and we'll take a closer look at market profile and Bookmap. Okay, so looking at the monthly chart, obviously it's clear to see the momentum has completely flipped. Right? We now have 3 months in a row where we have lower highs and lower lows. We also have a lot of momentum in this monthly candle. So this has told us that the momentum up has rolled over and we are beginning momentum down. This doesn't look too dissimilar to me to this candle right here, where we had our kind of rollover. We started our momentum, higher highs and higher lows on the monthly. Then we got a nice big candle that broke through previous all-time highs. That led to quite a bit of momentum to the upside. Did it not? Months and months and months of the market going higher and higher and higher. Well, we have a very similar pattern right now, but going the other direction. Does that mean we're going to have this big of a move to the downside? No, not necessarily, but it is just showing how momentum looks. First you roll over, then you get excess. Well, now you know you're cooking. You're moving in that direction. So on a monthly time frame, this is pretty bearish to see. It is worth noting that, we're at the end of the month tomorrow. So we'll be printing a new monthly candle soon, but it is bearish for now. Let's take a look at the weekly. Again, we can see that momentum down. We've been looking at this channel over the last few weeks, which is a sign of momentum down. It's been a very sideways type of momentum, up and down and up and down and up and down, obviously because of all the, back and forth with what's going on in the war. That's caused a lot of sideways chop. But in general, the momentum has been down. Okay, and that's what we're keeping track of. Very importantly, last week we broke below this channel, closed below this channel, and we are now set to open sort of right at that channel low, which we'll take a look at here in a second on the daily. And that is also a sign that you have a lot of momentum down. So looking at the monthly chart, the market is telling us we have momentum down. Looking at the weekly chart, the market is telling us we have momentum down. Let's zoom in and let's take a look at the daily chart. Well, there you have it. Same thing we were just looking at on the monthly. So when we look at the daily, what do we see? We see that, yes, it's been incredibly choppy, just all over the place, But bigger picture, we've been drifting lower inside this channel. Well, what happened on Friday? We broke out of that channel to the downside, and over the weekend / at the open this morning, we are back testing that breakout, which means one of two things could happen today. We could either re-enter the channel and start to work our way up towards the channel high this week. Or if this holds as resistance today, we're going to have an even bigger move to the downside, because now you're combining not only that overall downward momentum, but break out of balance downward momentum, which is even more momentum. So all of this is very, very bearish. Okay. It should have us very, very bearish. As a matter of fact, at the close on Friday, we even had a spike down, which should have us very, very bearish. But this is where the market profile and understanding the auction process gives us an enormous edge in our trading. Because on Friday at the close, what was I saying to the people in the Pirate Traders Brigade? I was saying this thing needs a bounce. It needs to reverse and come back up. Why? Because the market can do something called getting itself overly short, overly fast, or overly long, overly fast. And essentially what that means is it's too emotional. The move happened too quickly, and they didn't give longer term, stronger hand traders an opportunity to enter trades. The market went down so fast, they didn't even get a bounce to sell. And that's what those longer term traders will do. That diamond hand money in the market that will stay in trades for multiple days, multiple weeks, multiple months. That time frame of operation only enters when they get a good entry. They don't chase price on the way down. So what's happened is the market has fallen, particularly over the last 2 days, over Thursday and Friday. The market fell so far so fast, they never got a chance to get short. And the market knows there's liquidity there. It knows that if it goes up today, even though the momentum is down, if it goes up today, it'll give a lot of liquidity a chance to enter the market to the downside. So we have to take that into account in our trading. Okay. We have to say, yes, there's a lot of momentum down. Yes, that's very bearish. Yes, we should assume we're going to head much lower, that we haven't made our lows yet. But that doesn't mean the market has to go down today. Today, it might actually go up. We might actually get a counter auction. And so then you start to say, okay, well, Charles, if you're telling me there's momentum down, and I should be looking to get short because there's momentum down, but you're telling me the market might go up today, how the heck do I trade this, right? So let me walk you through how this is going to work. There were, at the close on Friday, a bunch of levels that we call either weak references or references that need to be tested, okay? So the first was the base of the spike down. The second was the base of the single prints down. The third was the gap down. The fourth was the base of the spike down from Thursday. The next was the first set of single prints from Thursday, and then the second set of single prints from Thursday. And then very lastly, we have the high of the day from Thursday, which was a poor high. Every single one of these things, when we closed down here on Friday, okay, every single one of those needed to be tested. So think about it like it's a little magnet. There's a little magnet right there. There's a little magnet right there. There's a little magnet right there, right? There's these little magnets up here at each one of these levels. And the more of these magnets that we have, the more likely the market needs to at least try to go up and backfill those. Now, does that mean we're going to come all the way back up to the poor high from Thursday? Probably not, right? Getting to that very last magnet, that is not a high probability. But the more of these magnets that we create, the more likely we are to, at the very least, come back to the first of those magnets. Well, in the overnight, over the weekend, we did that. We took out the first two magnets. So those are gone. Right when the market opens here in about 20 minutes. Those magnets no longer exist. So already we've taken away a lot of that pull, that upward pull on the market, right? It's already kind of gone, a little bit of it. So if the market does need to go up, where does it need to go today? To the next magnet, which is the gap fill from the gap that we created on Friday, which would be the market going up to 65.21. That might be all the market needs. The market might come up there and then run out of steam and turn around and start coming down again. So when the market opens this morning, what we're looking for is a way to understand, do we need to go repair that next magnet? Do we need to get up there and fill that gap? Or do we have enough momentum that we can just start going down immediately, right? And for that, I use what I call a chop zone. So because we are opening inside yesterday's range, as a matter of fact, we're opening right at Friday's fairest price to do business, which means the market could go up or down from here. It's very uncertain, right? I need to give myself a range. I need to pick an area where it's like, okay, I'm not going to try to force trades inside this range because I don't really know what it's going to do today. I don't know if it's going to go up or down. I don't know if maybe it's going to go nowhere. So let me give myself some sort of context to understand what the market is doing so I can enter trades. So for me today, that chop zone, That area where I'm going to basically just watch and wait is going to be between the overnight high around 64.82 down to this little node right here around 64.35. Okay. So this node right here is very important to me. You can see there was volume there and time. That became support over the weekend. Interestingly enough, it was resistance at the second half of yesterday, okay? And it is a large cumulative node. So all of that tells me this is an area, right around 64.30s where something can change in the market. And what do I mean by that? I mean, if the market dips below there today and we start to bring in new sellers, we start to turn that into resistance, it's a sign this market wants to go much lower. At the very least, to get below 19, probably even to get below 63.99. Okay. So getting resistance in this area would be very bearish. We'd be turning support into resistance, which would be a sign the market is going to go lower. That's why I'm choosing that as a chop zone low. I'm choosing the overnight high because anyone that's been going long in the overnight, let's say they bought down here, they bought in here, they bought in here, they're buying right now. Anybody that goes long in the overnight, they're going to start to take profits at that overnight high. So that's a place where the market could run out of steam going up and turn around and start coming back down. So as long as we're inside this box, as long as we're inside this chop zone, there's really no trades for me to take. I just don't know what the market's going to do. But once we get to an edge, I'll find out. We get below the chop zone low, we get new selling. I'm bearish for the market to go lower. I'm targeting moves towards yesterday's low. Okay. We look below that chop zone low, we come back up. The market's telling me we need to spend more time going sideways. We're going to stay inside the chop zone for a while. If I wanted to, and it would be contextual at that moment, I could take a long, targeting a move back up towards the opening price. Okay. If we open and we push up above that chop zone high and we start to turn it into support, that is the market telling me we want to try to fill this gap. Okay. So the first move would be we turn the overnight high into support. Then we look to get to yesterday's high, Friday's high, around 64.96. If we push above that and turn it into support, then we can feel very confident we're going to fill that gap. So I could choose to go long at the overnight high, take profits at the previous day's high, and then re-enter the trade, or get long at the overnight high, stay in it to fill the gap, or do nothing. Just watch the market find support at the overnight high, wait till it gets above Friday's high, and then go long with support up there. Any of those trades gives us a high probability opportunity because we know the market has gotten itself overly short, overly fast, and it needs to balance this off a little bit with a bounce. We know we have the gap, which is an obvious target to take profits. So we also know that if we're going to get there, if we're going to fill the gap, we are first going to turn the overnight high into support. Then we're going to turn the previous day's high into support. So both of those give us a chance to get long with very little risk because it pretty much is once it gets above there, it's got to stay above there. So you don't have to have a huge stop to get that trade. You can get in with a nice tight stop to get that trade. So if I'm looking to go long today for that gap fill, which is absolutely possible, as this market has gotten itself overly short, and we do have a lot of magnets, that's how I want to do it. I want to see support above the overnight high, get in, lock in profits at the previous day's high, support there, get in, lock in profits at the gap fill. Now, let's say all of that happens. We get there, we fill the gap, and then we get resistance, right? We can't get up into yesterday's range. Or we get up and we fill the spike down and get resistance, and then we reverse. That is extremely bearish to see because we started today's stream talking about how much momentum this market has to the downside. It is a lot of momentum. So if they repair that first little magnet, which is the gap fill, or that second one, which is the base of the spike, and then they instantly turn around and start heading down, well, brother, watch out. Because that means those longer term traders, that those stronger hands, that money that is going to stay in the market for longer, it got short. It used that bounce, it got short, and now that momentum to the downside is about to immediately pick up once again. So that's how we're going to play it if we go to the upside. Now, let's say we start to move lower. right? It is possible that this bounce right here is enough. It is possible that the moment the market opens, those longer term traders start to sell the market because they're thinking they're not going to get a gap fill. This is as good an entry as they're going to get. So if that is the case, what's going to happen is first we'll get to that chop zone low. Okay. We'll start to get resistance down there. Okay. In which case the first move is for the market to get back inside the spike down from Friday. So get back down below 49.19. If we get below there and we get new selling, that tells us we definitely still have momentum and we're probably going much, much lower today. Okay. So we got to take this one step at a time, and you got to be able to hold two separate ideas in your head at the same time. You have to know that on a longer time frame, the momentum is down. So if you are going to be going long today, you want to take profits quick. You do not want to fall in love with those trades because it could reverse at any moment and start going down. But you also want to be able to recognize that we've gone way far down, way fast, and that we might need a bounce just to cool things off. So that's what the chop zone is for. And we'll have to just wait till the opening bell rings to find out what comes next. If you are watching this in the YouTube, let me know your comments, questions, concerns, criticisms in the chat. And if you are watching this in the Discord, you can head on over to the English traders floor and you can leave your questions and comments there. Good morning to Stephen and Trader. Welcome, welcome. Real quick, I also wanted to mention, this is actually pretty fun, so it's worth mentioning. Bookmap has decided they're going to do another one of their desk picture competitions. So this is like really simple. It doesn't start till Wednesday, till April 1st, but after Wednesday, basically in between April 1st and May 3rd, so you got a month, you can post a picture of your desk, okay, where you trade, anywhere on you know the internet, on X or LinkedIn or Instagram, and you just use hashtag bookmapdesk, okay? And then they're going to choose the best desk, the number one and the number two that they think. And the only really rule is you got to have Bookmap up on one of your screens. But other than that, anything you want, any style picture, any context you want to give it, you can. And they're just going to pick the one that they think is the coolest, right? That's going to be their favorite desk. And if you win, if they choose your desk, you get $1,000. You get a year of global plus the data, and they will hire a professional photographer to come to your house and take like a legit professional photo of you with your desk, which is just fun to have, right? So if you are interested in doing that, all you got to do is take a picture of your desk, post it on social with the hashtag bookmapdesk. And for the second runner-up, they're going to get $500 and a year of Global Plus. Okay. So this is a lot of fun. We had a few members of the Brigade do this the last time around, and it was great. It was great to just kind of see the different environments that people trade in. You know, some people, it's just them all alone with like a little laptop in like a plain white room. And other people, man, they have like LED lights covering all the walls and these crazy decorations. And they've got 8 screens. And, you know, it's just so funny to see, you know, people are just so different. And it's fun to see kind of the differences in the way people approach their workspace. So that would be a fun one if you're interested in trying that out. Any questions on anything I've said thus far today? Let me know in the chat. Good morning to Silver Media, Jay, Shk230, Will, Exploring CME. Tom says, oh, it's Monday. Monday, yes, 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 yes. I need coffee. Yes, yes. Trevor in the house. Good morning to you. Crypto Writer is here. Bogdan in the house. Bell says, what DEX tell you today? It's a little too early, I think, to look at GEX levels. You know, it just isn't really that relevant pre-market. The minute that opening bell rings, all those levels are going to start to change and adjust because obviously there's going to be a lot of participants that are entering trades after the opening bell, right? Remember, a lot of this has to do with arbitrage. So somebody decides they want to buy or sell Tesla. You know what I mean? They got to wait for the opening bell. They got to wait till the market opens to start trading Tesla. As soon as Tesla's price starts to go up and down, people who are trading options on Tesla are going to be taking trades. Those options are going to affect the underlying assets, which are going to affect the indexes, which are going to affect the futures, which are going to affect the SPX. You know what I'm saying? All of these things, there's a rippling effect and they're all connected. So if I'm looking at GEX, I'm going to wait probably at least 45 minutes. Generally at least 10, 15 minutes after the market opens, just kind of let all the ripples flow through real quick. Then get a better idea of where those things might take us. So for now, I would say prior to the market opening, all we really need to see is price action, right? Where is the market going? Where does price go? How much time does it spend there? How much volume does it bring in? And then what's happening with the order flow, right? That's what we're using Bookmap for. How are things changing in terms of order flow? Are they adding orders below? Are they adding above, right? Are they pulling or are they letting things fill? Are we using a lot of icebergs to trade the market, or is it more of just natural moves? Or large players getting stopped out or not, right? This is really the context first thing in the morning that's going to be a little more helpful. GEX, like I said, give it 15, 20 minutes and you're going to get better signals from those levels. One of the big surprises to me diving into the world of GEX, I was led to believe that options market makers were the tail that wags the dog, right? That options make the market move one way or another. And so if you can open up a GEX chart and you can see where the key levels are, you know what the market is going to do. And what I learned from sitting and watching that over and over again is GEX is just as random as everything else in the market. Okay. It changes just as quickly. You could get a signal where you're like, I am absolutely sure we're going to this certain gamma strike level. And then 20 minutes later, you look at the chart and that gamma has completely evaporated. Right? Why? Because something happened with price action. Somebody adjusted their trades. The market makers adjusted their trades. That can happen in a flash. It can happen instantly. And so GEX is just another tool to read the randomness of the market and give it context. It does not control the market. Okay? That's an important thing to understand. The market will always be random. Now, you can make the argument it has massive effects on the market longer time frames, right? Especially when you're talking about getting to major options expiries and the week before and the week after a major options expiry. You can definitely say that the options affect the market in that way. But if you're talking about intraday, I want to go long or go short right now because of a gamma level, those levels are changing just as fast as any other data that you would look at. And so you need context, which is why I say you gotta wait and let that thing bubble around a little bit first thing in the morning and sort of establish itself before you start to look at those levels. Laura says, NQ, please. Yeah, let's take a look. Let's take a look. It's on the queue. We'll figure it out. Okay, so NQ, the setup is exactly the same as the ES. They've been moving very much in sync with one another, which makes sense. Yeah, it's almost exactly the same playbook. So you have the market even shorter than the ES. The ES only has one unfilled gap, but the NQ has two. So that's some big magnets above price, telling the market, hey man, yeah, we have momentum down, but we might need a little bounce first before we continue that momentum to the downside. So I would say pretty much step by step, it is exactly the same for the NQ as it is for the ES. Yeah, almost identical. So I would make your chop zone the overnight high to this node right here around 23,390. Okay. So if this holds as support, you're just going to keep chopping. If you get below it and it becomes resistance, then you're going lower. Same thing with the overnight high. You get above it, you find support. You're going to test Friday's high, 23,664. If you get above it and you fail, you're going to go sideways more. Okay. And if you get up inside Friday's gap, there is a significantly higher probability that you will fill that gap. that you will poke up and get to 23,776, and you'll be looking for support at Friday's high to trigger that move. Okay. So both markets are going to open in a chop zone. I do expect there to be a lot of chop. I do also expect there to be at least one fake out at the chop zone high or low, whichever one to test first. So meaning it'll poke above and come in at least once before it turns that into support and continues. It's going to be a choppy morning, but we've got our chop zones and we'll just watch and wait and see which way it breaks. In the wise words of Charlie Munger, the money is not made in the buying and selling. The money is made in the waiting. And this morning is one of those mornings. We got to wait a little bit until we know we have an edge. Step into the chop zone. Triple seven. Says what happened last week's stream? You suddenly disappeared. You mean the Bookmap stream? I don't remember. I'm here. I'm alive. Chester in the house. Good morning to you. Guillermo is here. Frito. Sup, y'all? Michael in the house. Good morning to you. Willie T is here. Bogdan says, I think there should be a small spike to the upside just to taunt the bulls. It would be too easy to just fall under 1,000 points. Kathy would go nuts. Yeah, so you say it needs a spike up to taunt the bulls. I see it more like it needs a little bounce to give stronger hand sellers a chance to enter the market. Okay? But here's the thing. If they don't get that bounce this morning, they're not going to wait around. Okay? They're not going to chase price down. So if they don't get the bounce to get short, they're going to get short inside Friday's range. And we're just going to keep going straight down. So, patience is going to be key here this morning. If you made me guess which is more likely, the market heads up to fill the gap or the market immediately sells off and heads below Friday's low, I would call it 50-50 right now. Okay? So we got to wait for that opening bell to ring and see which of the two is going to happen. The good news is both give us huge indicators, right? The move up tells us there's an extremely high probability the market is going to fill the gap, right? Once we get new buying above Friday's high. So that's a good play in terms of probability. And the move to the downside is good in terms of risk to reward because you could target moves all the way below yesterday's low, even down below the overnight low. So both trades, whether the market breaks higher or lower this morning, are excellent opportunities as long as we can wait until we're sure which is happening and that we don't try to guess and try to front run it. Because then, the market's going to squeeze. And if everybody tries to front run it to the upside this morning, guess what the market's going to do? It's going to poke below that chop zone low, then turn around and go up. And if everybody tries to short it this morning, what it's going to do is first it's going to go up, then it's going to turn around and come down. So we got to let them chop it up until we know who's in charge. That's just the way it is. Do-do-do, do-do-do, do-do-do. Some things will never change. Frito says, it looks like Papa Powell is speaking right at the open. Oh boy, well that just adds more reasons for chop. Zenveg says, what is your bookmap setting for volume minimum? That's a lot of red. I think I have it cranked all the way up. Yeah, I like to be able to clearly see, where the volume is differentiated between other levels. So I have it like cranked. If you are looking at stops and icebergs, you'll notice this, I generally only do very large liquidity as well. So these are only going to pop up when it's large orders, 40, 50 contracts at a time. So for example, this iceberg down here at the current low, 64.60, has only filled 2 contracts. Let's say it comes back down there and it only fills like another 8 contracts and then it disappears. It will literally disappear from the screen because I just don't even care. I just want to see the big players. What are they doing? For obvious reasons. Because it's a chop zone. There's a question here. Is that bookmap on the left side of the software? No, that is called Window Trader. It is a market profile chart. So the chart on the right is order flow. On that chart, I'm using it to see the way liquidity is entering and exiting the market. Where do they start to add liquidity? Is it as the market is going down? Well, then they're trying to scare price away. Okay, cool. Now I know what that's doing. If that disappears, it's going to stop scaring price away. Here we go again. They just added more liquidity right here. It started to scare price away. They just disappeared it, which means we're going to come back down again. So being able to see those changes in order flow help me to understand what the market is doing. And then over on the left side of the screen, this is a market profile chart. So this is for price action. This just shows me where did the market go? How much time did it spend there? How much volume did it bring in? The difference between volume profiles and order flow is that volume only shows up after those contracts actually changed hands. So this data is telling us for sure this many contracts changed hands at this particular level, whereas this is telling us how many contracts might change hands at a particular level. A lot of the order flow ends up spoofing, it ends up disappearing, but that too is important data. If you have a large support level with lots of liquidity where you're expecting a bounce, and then right as the market gets to it, it disappears, well, now you're no longer expecting a bounce. So you want to know that. You want to recognize when those changes happen. But for now, there's not a lot to say here. Inside the chop zone. We just got to watch them chop it up. So I'm going to mark some support levels here where we might look for a bounce in price. If we get it, we get a clue that we're going to keep chopping. If we do not get support, it starts to build bearish momentum. Okay. Screen's getting messy. There we go. So we are pushing into the first potential support right now around 52. If we get a bounce here, we'll look for the market to turn around and go back up through the opening price. If not, we're looking to come down and test 46 for a bounce. Okay, no bounce on the first support. That's a little bit bearish to see. Good morning to Bull Hunger in the Discord. Welcome, welcome. Good morning to Auntie. The chat is saying Powell doesn't start speaking for another hour. Well, yippee. We'll look out for some volatility when he does. Who knows? Bogdan says the small house icon is an iceberg. Yeah, it's supposed to be an iceberg, man. It's not a house. That's funny. But yeah, that's the iceberg symbol there. So this is that iceberg at the low. They fully filled it. And in total, it was 429 contracts. There was one up here that they fully filled at 146 contracts. And then this one right here that looks like a little stop sign, that's a stop that got taken out for 90 contracts. Okay, so far this is bearish. We push to the low and we're bringing in new sellers at the low. We're looking for a bounce right here around 45, 46 and a reversal back up. There's a question here. Can one get in a trade following huge icebergs? I know where your head is at, but that's actually not a good idea. Okay. So one common misconception that people have when they see a trade with size is they assume that means that the player that's trading with size knows what the market is going to do. Okay. So this is where we're looking for a bounce. If we get the bounce, we're looking to head up and test, 64.59 for resistance. If we don't, we're heading lower to 64.38. So what a lot of people assume when they see size is that it means that whale knows something. They know that they're going long because they know the market is going to go up or go down. That is not the case. Okay. First off, they're wrong as much as anybody else. But second off, a lot of times they fake things to test the market. So let's say a large player comes in. They're selling the market in the overnight. They're going short. They're going short. They're going short. They're going short. They're going short, right? And they build up this big short position. The market opens. They come down. They exit, 400 of those contracts all at once in the regular trading hours. So they're locking in a little bit of profits. But really what they're doing is they're testing to see if there's bullish momentum. They're trying to find out, do we want to stay in our shorts? Do we want to add to our shorts today? Or is the market going to bounce and get up and out of here? So they'll do that. They'll go long, with a bunch of contracts all at once just to see if it causes the market to bounce. If it doesn't, well, then they know the market's going to continue lower that day. So just because you see somebody with large size going long or going short using icebergs doesn't mean the market is going to go up. Not at all. Also, you never know if they're entering or exiting because they can use them as ways to take profits as well. So it might be that, sure, you see 450 contracts go long, but that might be somebody who got short getting out of their long, or it might be somebody who's getting long and you don't know. You have no idea. So the only way I really use those icebergs and that size is to recognize, first off, who are the market participants? Right? If a market is bouncing at a certain support level over and over again, and I see that it's icebergs every time, well, I know that's a very weak low. I know that that's not going to hold because that's telling me it's bots. It's day trading bots trying to get a reversal there. You know what I'm saying? Whereas if I see one huge iceberg come in and then the market reverses, well, that I can trust. Or if I see no icebergs, then I can trust it much more, that support level. So it's just a way to recognize who are the market participants that are doing business at a particular level. Also, when we talk about chop, sometimes the market just gets like a multi-day time frame where it just grinds around in a really tight range. Obviously, we don't have that going on right now because of everything that's happening with the news, but we do get those types of markets. And again, you can see it by looking at the icebergs, because there'll just be icebergs on both sides of the market everywhere. Every reversal will be an iceberg. And that's when you know it's just bot shenanigans. They're just grinding the market around to squeeze short-term traders one way or another. And so that helps you to understand how you want to do business in that market. Speaking of which, okay, first move is to the downside. So things are gearing up to get bearish, but this might actually be at a better place to be looking to get long than to get short. If this market is going to continue lower, it will push below 32, come back up and start to get resistance. That's where we start looking for shorts on the break, back test, and resistance, because otherwise it'll take about 2 seconds for this market to go boop, boop, and come right back up through that opening price. Inside the chop zone. It's worth noting we have not had any support yet today, and that is bearish to see, but that doesn't mean the market's ready to go down. It's just giving us a heads up of what it's going to do later. Sonny says, what do you mean by bounce? I mean, market stops going down and turns around and starts going up. So the market opened here, came down to here. If we get a bounce, it'll turn around and come back up. And it might happen literally right now. So we think about support levels as places where buyers might start to buy the market. And we think of resistance levels as levels where sellers might come in and start selling the market. We never know if a support level is going to hold or not. We never know if there's going to be a bounce. But we know where to look and we know what to look for. And so when the market gets there, if it's getting that bounce, we know what to do next, right? Inside the chop zone. There's a question here. Do you consider the cumulative volume delta when looking at Bookmap? Okay, so cumulative volume delta is great. For me personally, I don't look at it just because there's just too much for me to look at. Okay, so there's like the thing about Bookmap is it has so many incredible tools that if you were to try to use them all, your brain would just explode. It would just be like, this is too much to think about. It's too much information to diagnose. I can't keep track of all of this. So you got to just choose what parts do you find to be the most helpful for you. That cumulative volume delta, you know, if you're looking at it down here on the lower chart, can be very, very helpful to understand shifts in momentum. Right? When the delta is building lower, you got bearish momentum. When it reverses and starts building higher, you got bullish momentum. So it can be very helpful, but it's just so many extra things to think about that I don't look at it personally. Okay. The ones that I use for Bookmap is obviously the order flow itself, right? The heat map, the changes of contracts. Okay. So let me just pause on that conversation. We are not holding this support. This is bearish to see. So no bounce means we need to poke below the chop zone low and look for buyers there. So yeah, I'm using the order flow is the main thing. So, you know, if you look at this white line that's right here, whoops. If you look at that white line right there, on the right of that line, that's the current order book. That's where liquidity is right now. And then you can see to the left of it how it changes over time, right? And so recognizing those differences, that's the main reason I use Bookmap right there. Okay. The next thing is the stops and iceberg setting. And then the last thing is this right here, the market pulse, which I use the volume pressure imbalance. So this is just showing me when there's an extreme imbalance between buyers or sellers. If it gets above 95%, it'll make a clicking noise. You guys will hear it. You'll hear a click, 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 click. When that happens, somebody's sweeping the order books. So at that moment, the market is going to change. Probably we'll get one right now as we push through this chop zone low. So the idea is it'll go click, 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 and then it'll start coming back up. During that moment that it was going click, 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 it was just taking out stops. That wasn't really new sellers. So from that moment, if you get more selling pressure, the market's going lower because you're bringing in new sellers. Or if from that moment you don't get selling pressure, you're going to reverse because you just squeezed all the sellers and now you're going to head up and squeeze all the buyers. That's the way it works. Okay. 7-7 says maybe the icebergs are Trump's insider. We would never know. Okay. So inside the yellow box, inside the chop zone, we have no edge because anything can happen. It could have reversed anywhere. But now as we poke below the chop zone, this is an area where the market generated information can tell us for sure what's happening. If we bounce and we come back up, it's going to be more chop. We got to wait. If it comes down here and we get new selling down here, like we got here and here, then we're definitely going much lower and we will be bearish for the day. So moment of truth for the buyers. If they want to reverse up and out of here, it's now or never. They need a bounce. Lest the selling pressure takes them all out. Nope, no support yet. Wow. They just keep on selling. Yeah, they keep on selling. Okay, moment of truth. If this turns into resistance and another wave of sellers steps in, market's going lower today. If not, more chop. It's an exciting moment. We're waiting with bated breath. We're on the edge of our seats. Steven says the euro bounced earlier at the New York session open. I was short and then it failed and now seems to be heading lower. Say it ain't so. Gallo says, could you explain the chop zone, please? I wasn't there before. Well, you got to rewind the tape. All right, so we are getting a bounce, which is telling us the chop will continue. So the question was, what is the chop zone? Can I explain it? The chop zone is basically the area where I don't actually know who's in charge of the market, right? I got to get to one edge of the range or the other to find out. And that's why we're down here right now. That's why I said, ooh, we're waiting with bated breath. Because from here, there's only really one of two things that can happen. Either the market is going to head down for yesterday's low, or it's going to head back up for the half back. Okay? Guaranteed. One of those two things is going to happen. And so if I want to enter a trade right now, I just need to decide, which do I think? Do I think we're finding support and we're going to head back up, or are we getting resistance and we're going to head lower? And the probabilities work out in my favor of using tight stops, no matter how I choose to trade that. So it's just a range, like an edge of a range, where you can minimize the amount of risk that you have to take, and you can have a higher probability of whatever you think is going to happen happening. Okay? When you ask me, how do I choose my chop zones? That's a whole much more complicated conversation about how I read support and resistance levels and where I look for changes in the market. I stand corrected. We are breaking out of the chop zone. All right, we're bearish. So now we are doing something that we call monitoring for continuation to the downside. There's basically certain processes that the market should go through if it's going to keep going down. So the first is we're going to re-enter the spike down from Friday. If you don't know what that is, don't worry about it. Basically, it just means get below 64.19. If once we get below there, we start to bring in red candles, we're going to keep going down and get below Friday's low. If we get down below there and the volume tapers off and we reverse, well, then we're coming back up to test resistance. Okay. Either way, the momentum is to the downside now. Okay. So either way, if we're looking to enter trades, we want to be selling at resistance, taking profits at support. We don't want to be trying to catch the falling knife, so to speak. We don't want to be trying to figure out where the low tick of the day is and go long for the reversal. We'd much rather let the market come down, come back up, and then sell in resistance for the next move down, rather than try to figure out where is the low and let's try to catch that low. Because now that we're breaking out of the chop zone to the downside, and quite frankly, the way we're doing it is just very, very bearish. There has been no bounce at all. We spent a little bit of time grinding at these three areas, which were all potentials for a bounce, and we didn't get anything. So that just tells us these sellers are absolutely in control of the market. And so if we get below the base of the spike and we get new selling, if the sellers are in charge, where do they want the market to go? Well, they want it to go below Friday's low, right? And if we get below Friday's low and we get new selling, where do they want the market to go? Well, to the week reference at 63.88. And if we get below there and we get new selling, where does the market want to go? To the overnight low. And so we're just monitoring for continuation lower. Each time we get below one of these key levels, do we get new selling? If we do, they're going to keep going. I will say this is further adding to my narrative of the market getting itself overly short, overly fast. But as long as they have the momentum, we don't fight it. Because it will shock you how far they can push the market when they have the momentum. Also, for those of you guys asking about the chop zone, now that we have broken out of that chop zone to the downside, it no longer matters. It means nothing. It only mattered on that first test of the low. If we'd have looked below and failed, well, then we'd have more chop. Now we can come back up into there and get resistance and continue lower. This is bearish. So the next thing I'm going to start to pay attention to in this process of monitoring for continuation lower, one way you can get an idea if the market is going to keep going down is if with each new poke to the downside, we're able to take out more stops. Okay. If each time we poke down, we take out more longs and more longs and more longs, then the market will just keep going down as long as it's able to keep taking out stops. The two ways that we can see those stops getting taken out is going to be either just straight up with the stops indicator, which you can just see each new poke, we're taking out more stops and more stops and more stops and more stops. Okay. Also, you can use the volume dots on Bookmap as well. So anytime you see a volume dot, if it is red, that is telling you there are more sellers at that moment than buyers. If it is green, there's more buyers than sellers. And the size of the dot is how much of an imbalance. So a little dot is telling you that there's just a few more buyers than sellers. And a big dot is telling you way more sellers than buyers, right? So we're monitoring that process. And also, very importantly, where is the volume dot? Is it at the high or the low? So if you make a volume dot at a low, that stop's getting taken out. If you do it at a high, that's new sellers getting in. Okay. So as long as we keep seeing that each time we make a new low, at that new low, we've got a big volume dot, a big red dot, it means we're still taking out stops. Okay. And as long as we keep taking out stops, the market can keep going down. Think about it as the market is just a hungry animal, and all it does is eat liquidity. It doesn't care if it's long or short. It doesn't care what price level. It doesn't care if it slowly grinds or if it flies right through a level. It doesn't care about any of that. It just wants as many contracts to trade hands as possible. And if going down is causing more contracts and more contracts and more contracts to trade hands because you're forcing longs out of their trades, well, guess what the market's going to keep doing? It's going to keep going down. until it gets to that point where there's no more stops, right? Until it's squeezed everyone it's going to squeeze. And what will it have done in that process of going down? It will have gotten a lot of people short, and there'll be a bunch of stops above. So as soon as it stops being able to take out stops on the way down, it'll turn around and start heading for the stops above. That's the auction process. That hunt for liquidity. I like to think about it like a shark that can just smell the blood in the water. And it will always swim to wherever that blood is. And that blood is stops. Sheena says, why are the ticks positive? I doubt they still are. Oh, you're right. Ticks being positive means people are buying stocks. So that means we're finally getting a bounce. An excellent point to start looking for resistance. The market has told us the sellers are in charge. So we probably would rather be shorting than going long. So seeing that we're getting a bounce is doing what? It's giving us an opportunity to get an entry on a short. And so if you say to me, well, Charles, I can't get short with the ticks like that. I just can't trust it. Well, then step aside. Nobody says you have to take trades. Only take trades when you feel confident. I feel confident the momentum is to the downside. I feel confident that we will get resistance and make a new low. Why do I feel that way? Value area up against the low of the day, bearish to C. As the market has worked its way lower, we have brought in new volume at each new low. That's bearish to C. Value is overlapping to lower. That's bearish to C. We got an iceberg at the low. That's bearish to C. Bearish, 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 bearish. One bullish signal, the ticks. Okay? So that's not a reason to outweigh the bearishness, in my opinion. This is what we talked about earlier on in the day when we said, if the market doesn't open and push above yesterday's high right away, longer time frame sellers, swing traders, strong hands, diamond hands, they're going to get short and they're not going to wait around if they don't get that bounce. So they're going to be looking for the very first opportunity to get short. And once they do, down it goes. The struggle, when we talk about this idea of the market getting itself overly short, overly fast, it falls so far, so fast, it doesn't give those longer time frame traders a chance to enter their shorts. So like the further it goes down, the more it needs a bounce type of thing. The struggle with that is the idea that momentum can shock you. Like the market will always go further than you think it will before it gets that bounce, but it will eventually get it. As long as you know you have momentum, you know what to do when you get that bounce, which is go with the momentum. So if you went short the market at resistance, now would be a good time to go ahead and put your stop below your entry. The trade should either continue lower or come back up and stop you out, because that would mean we need to test the next resistance. Unfortunately, I have to say goodbye. I am stepping on Bruce's time here. If you are new to trading the Bookmap, you might consider heading over and checking out Bruce's live stream. He'll be able to walk you through all of the specifics of how to use Bookmap and answer all of your questions on all the little, idiosyncrasies that make it such a great app. If you are not a member of the Brigade, you might consider joining. I do these live streams every single morning. And so if you might find it helpful to have, my guidance as you go through the day, it's only $20 a month. So literally, if you went short after I said I'm bearish and I drew a resistance level and you just moved your stop 2 ticks below your entry, you've just paid for your entire month of Pirate Traders Brigade. Congratulations. You're covered. So if you think that might be helpful to you, well then, consider joining the Brigade. There's a link at the top of the screen. It is piratetraders.io/join. $20 a month. We'd love to have you. If you are a member of the Brigade, head on over to the live stream and I will see you there in about 2 minutes. Thank you guys very, very much. And we'll see you next Monday. Have a good one.